Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Teaching Tech Tuesday. Let's take a look at the parallels to 2017 of the current market, because it definitely feels a little bit like Groundhog's Day. Punxsutawney Phil saw his shadow in Gobbler's Knob over the past week, so we do have 6 more weeks of winter. Just thought I'd throw that in there. But from a trading perspective, we can break this apart into a few different ways. The first, most important to me, obviously, is technical analysis. We'll take a look at that. We'll take a look at some on-chain stuff, news and events, and then what was happening in legacy land in 2017 versus now. And I think the easiest math metric ruler stick that you can use from a technical perspective is always going to be a trend metric. I prefer the cloud, obviously. If we look at the weekly cloud in 2017, what did we see? We saw repeated bounces on that blue and red line, the Tenkin and Kijun. We saw repeated mean reversions and moves higher. And probably most importantly, we actually saw just continuous buying despite news events pulling us lower. We had, of course, the Bitfinex hack back here in August 2016, 200,000 BTC. We had some China banned Bitcoins headlines. We had some China banned exchanges headlines. We had banning of ETF headlines. We had the BCH fork. We had Roger Ver selling. We had SegWit. We had the New York agreement at the top. So it was a constant mirage of not necessarily external headlines, but internal headlines for Bitcoin, governance of Bitcoin, market access for Bitcoin. And we've had a similar situation since 2023 with the ETFs, right? So that is certainly very similar. And just looking at the position of the Kijun here, the mean reversion level would be around 75. I don't think we're going to 75, but if we do go to 75, then the cloud is saying this isn't over. It's just saying that's a full mean reversion. That would basically be the election breakout area. But that would be equivalent to what we saw in 2017 several times with price pulling back. In 2017, a lot of this was not pretty to live through, to trade through. It was a lot of hurry up and wait, a lot of chop in between moves higher. So it's just a reminder again that this is a marathon, not a sprint. We certainly saw that last year with most of the year being downwards chop. But the cycle over stuff, based on math, again, based on the cloud, doesn't happen until we're below the weekly cloud, ultimately. If we look at 2018, if we look at 2022, that is the last support. And that is currently all the way down at, 40, 50, 60, right? So that would take some time to fully negate. What we don't want to do between 75 and 60 is what we didn't do in 2017 and 2018. We never broke below the Kijun. We never tested this dead zone between the Kijun and the cloud, right? Until the very end. So we really do not want to be anywhere below 75 for any period of time. We can also look at the 20-week moving average. Very similar story. Repeated mean reversion tests until the very end. You can, of course, measure the distance from 20-week to just see how overheated are we. Currently, we're almost touching the 20-week. We touched it briefly-ish. It's around 88. It'll keep moving up. For the most part, in bull or bear trend, we are above or below the 20-week. That is the litmus test. 2020 was no different. Post-COVID, we held above the 20-week really until the very end. Bear markets are the same. So it's certainly my preference to not squirrel around anywhere below the 20-week. And we really didn't do that at all in 2016 or 2017. If we look at ETH, similar story then versus now, except now it is not following those rules. It is below the 20-week moving average. Look at 2017, it was above the 20-week. The entire time, the entire run, it was above the 20-week. Weekly cloud, very similar. This is danger zone territory, just applying basic trend metrics here. Everybody's got to decide what they're going to do with their own stack, but this is problematic to be back in the cloud, below the cloud, again on the weekly for ETH. Much like BTC, the end of the run for ETH was always below the weekly cloud 2018, 2022. So the thesis for ETH, just based on trend metrics, is not there relative to what BTC is currently. It's hard to look at many other assets in the same time frame, just because there weren't many trading back in 2017. But in general, this is a blueprint you can use for both BTC, ETH, and anything else. So could this get uglier? It could, and it did certainly in 2017. On a mean reversion front, it's not always going to be up only, and this stuff takes time. So what you want, if this is truly a repeat of 2017, you want these fits and starts, you want mean reversions, You want news events to slam us down. The issue here is the tariffs, the global trade war. Panama has caved, Greenland has caved, Canada has caved, Mexico has caved. China, I'm not so sure. China, we may have some trouble pushing our way. But if we get these repeated retaliatory tariffs between China and the US, that was very similar to what happened in 2018, and I'll get to that at the end. And 2018 obviously was not a pretty picture for crypto. Before I go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overall Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Paired Ventures Inc., PVI, DBA, Kraken. We can also look up the seasonality, 2017. Obviously, we had 4 straight quarters of bullishness in 2017. That may be more challenging to achieve this go around. A month in, so far, so good. And ETH was also, 2017 was very bullish for ETH, whereas it has not been bullish for ETH. So it definitely feels different this time for ETH. ETH also had in 2017 people buying ETH for ICOs. ETH does not have that this go around. In fact, it has a competitor, Solana, where people are buying Solana to effectively gamble on the Solana casino, much like the ICOs on ETH in 2017. So in no way, shape, or form really, from a technical or fundamental level, is ETH performing like it was in 2017. The only difference is, of course, the ETF, and that may be coming for Solana as well. Back to Bitcoin, if we look at performance since the cycle low, you compare these across all the cycles. Eventually, yes, we will get diminishing returns. The cycles will flatten out. We will not have cycles anymore. Certainly possible. But if we look at what this mirrors currently, more than anything, it's again the 2015 to 2018 cycle. The last cycle, 2018 to 2022, at this point, we were basically at what ended up being the top for the cycle. Now we tried again later on in the cycle to make a new all-time high. It didn't really make that much more of an all-time high beyond what we had already put in around 800 days. So if we see a meaningful acceleration here within the next 50 days into Q2, then to me that would mean there's really no difference between this cycle and 2017, at least up until this point, right? Another thing you'll notice in 2017, what happened, January was kind of a bust. February, we started to accelerate later on in the month, reset that in March entirely, and then finally got really going in April. So you just have to have patience and you have to pick your battles here. If to me or you, the charts look like jumbled nonsense, then, do less, size it down, do something else. But that isn't to say the cycle is over. But Q1 2017 was very volatile and very messy. If we look at Bitcoin since the halving, this is where you can see more or less the diminished returns effect. If we look at all the cycles here, it doesn't really look like anything, but it does look closest to 2017. And we're in the wheelhouse, just like we were on distance from cycle low, for an acceleration here potentially within the next 50 days. None of these cycles are going to be exactly the same, but it's certainly something to consider. If we look at relative to presidential election years, again, what does this look like? 2016, 2020, we were already moonshotting by this point, and then some. And again, you can see this January, February, March, Q1 stuff just get jostled around here until Q2 starts, and then we start to take off again. So Q1 in its entirety can just be a nothing burger and still give us hope for Q2. If we look at some of the on-chain metrics, MVRV Z-score, this looks at when people have moved coins on-chain. And if we look at 2017, MVRV is actually at a similar position today than it was in 2017 and started to accelerate in Q2 2017. So we don't have 100,000 cycles to compare to, but what we do have from many different angles looks like 2017. Here's realized cap hodlways. This is people moving coins on chain over the past 6-month period relative to the date. And again, we're seeing this uptick in coins moved on chain starting in Q2 2017 in a big way. So we're about at the same place we were today as we were in Q1 2017. Another thing I'll add, in Q1 2017, I don't think anybody was thinking that we were going to go to 20K. That may be the difference between this cycle and last cycle, or 2017 is, and then everyone was just happy to be at a higher price. I don't think necessarily there was some massive TA expectation for 20K, whereas today you have people talking about 300K, you have people talking about $1 million. So it's certainly different in that regard. But if you were just comparing these like to like, it definitely feels most like 2017. If you look at the dollar, DXY in the white there, relative to US rates in the red, rates are actually rising a little bit in 2017. The dollar came down significantly, and global liquidity in the yellow was also rising. So that's, of course, something else to continue to watch. Do we have a falling dollar? Do we have rising global liquidity? Now, we're not in the NERP-ZERP era that we were in post-COVID, so it's going to be harder for everything to do well. But the lower DXY goes, the higher liquidity goes, the higher the likelihood digital assets crypto has a lot left in the tank. Now, if the dollar goes to 114 or higher, then everything is in trouble. So if you're rooting for the dollar, you're probably not rooting for digital assets here. I thought I'd also look at the S&P relative to 2017. 2017 was actually a nice little slow ratchet up here on the S&P. This is the VIX in the bottom here. The VIX was quiet, descending, non-eventful. So there really wasn't much volatility here. It was a period of extensive low volatility, if anything. So the VIX currently has been spiking around post-COVID. It has been spiking around a lot since 2020, but we certainly don't want the VIX spiking if we are bullish. And risk assets prefer an environment of low volatility, just like 2017. So the closer we can get to this, the better risk assets are likely to do. And I'm a little concerned that we've already seen this 2017 period, right, on the trend channel, let's call it. And if we do get an uptick in volatility in 2025, which we certainly already have, largely and thanks to this global trade war stuff, then that would be a challenging environment for the rally on the bullish side. So in technicals, what are we looking for? Price above the 20-week, price above the daily cloud, price above the weekly Kijun. Always be mindful of mean reversions to those levels. On seasonality, Q1 can be junk, Q2 can be fine, no issues there. I think people have this idea in their head that Q1 has to be bullish just because it's been bullish mostly since 2021. But prior to COVID, Q1 was not the go time period. It was all about Q2. So to me, Q1 is not primed for much of anything. And then relative to on-chain metrics, we look the same. People are moving about the same stuff on-chain that they were in 2017. And any way you want to look at that, it looks very similar. This could be any period in 2017 before things started to accelerate. So we'll have to revisit this at the beginning of Q2 and see how bullish or bearish things ended up being. But you can devise a narrative and say, okay, if we're in a period of high volatility and dollar strength, then we're probably closer to 75. If we're in a period of lower volatility and dollar weakness, then we're probably closer to 120 plus in Q2. But even if we mean revert significantly, it's okay, right? It's going to be painful, but it's okay as far as the trend is concerned. That's all I got for this one. Let me know what you're rooting for in the comments below. Like, dislike, comment, share, subscribe, and happy trading.